and in the exciting space like DeFi. Welcome all of you who are joining us now. And I'm beyond excited to represent the Western chapter today, who put this event together for you, the Rise of DeFi. And such a hot topic because this industry is unfolding in front of our eyes. And basically just imagine if you're in 1973 when options started trading on Wall Street. So such new financial products are similar to, similar to that, financial products are being created right now in front of our eyes. And we managed to secure some of the leading protocols, some of the leading projects from the space of DeFi, or the ecosystem of DeFi. And this event is consisting of three parts. First, we have Demelza from CoinTelegraph. She's going to basically give us an overview what happened this year in DeFi, and also we will talk about predictions later. And in the second part, we have Ilya, who's going to basically tell us a few statements, and Stani and Gustav are going to debate that. Basically, the debate is among the three of them. And in the third part, we have a panel discussion with everyone, and Gaspard and Demelza is going to join us there as well. So let's kick this off. Demelza, the floor is yours, and very happy to have you.
Thanks a lot, Emmy, for inviting me to join. And I just want to say I'm a journalist, so the rest of the people on the panel are the real deal. But definitely thank you for having me on. I will kind of introduce us to DeFi. I'm not sure how much experience the audience has with DeFi so far. So we're going to take it from the beginning and just cover the basics. Full screen mode. Okay, can everybody see my slides in full screen mode? Awesome.
We do.
Okay, so basically to, I guess, introduce DeFi, the way that I like to think about it is we basically want to, build an entire financial service, entire financial system without intermediaries. So basically, how did this start? Well, if you think about it, Bitcoin was decentralized money. That was a great revolution that added competition again to money. This was fantastic. But as you know, Bitcoin is very volatile. So it's really hard to do loans with volatile assets. And this was, something we experienced under the gold standard. Different economists like Larry White and George Selgin have, discussed basically how monies that have inelastic supplies or are very susceptible to demand shocks can really change the price quickly and influence people's decision making. So we needed some type of stable currency, some kind of stable coin that could be the basis for more financial interaction, which would be loans or trading. So what happened first was basically, we had MakerDAO, and that basically started in 2017. And MakerDAO was a stable coin and also at the same time a kind of like miniature bank or like collateralized lending program. And the basic idea is this, if I go to take out a loan right now, would I want to take out that loan in Swiss francs or would I want to take out that loan in Bitcoin? And if I have to make repayments in Bitcoin, and I know that Bitcoin is more deflationary, and that possibly as I make those loan payments, it's going to get harder and harder for me because Bitcoin's value is going up in terms of not only nominally in terms of fiat currency, but also in real terms, in terms of what I can buy with it, purchasing power. I would rather take it out in something like Swiss francs, because it's stable or decreasing in value. So basically, we started out with stable coins, and this, this isn't that different from the history of finance of all humans, of how we all evolved in a financial way. It's just that over the last 10,000 years or so, we basically built a financial system that relies on counterparties. And now we're basically rebuilding that entire financial system within a span of like 3 years, but this time without counterparties. And after we figured out how to basically, use a medium of exchange, like gold or copper or seashells or whatever, we then wanted to start to trade assets. And that's where some of these decentralized exchanges come in, because now we can trade a money for another money. We can trade a money for a utility, like let's say a digital good or service. And that was kind of the revolution of the decentralized exchanges. Of course, many came out. You had Bancor, you had Uniswap, and now we just have a plethora of decentralized exchanges, and all of them have solve a different, they solve the problems in different ways. And then finally, we had lending and borrowing. So this was the next step of the financial system. So once we had stablecoin, we had a way to trade stablecoins. Now we have lending and borrowing, and this is really, we're starting to expand the whole financial system as much as we can without intermediaries, or the least reliance on them as possible. Some of the oracles still rely on people picking who's going to provide the price inputs and stuff like that. But anyways, to come back to this first slide, depends on where you look. So we were discussing this earlier. DeFi Pulse, I think, says the market's around 14.5 billion. DeFi Rate says it's around 13 billion. So I guess it depends on how you measure collateral locked up in these different DeFi programs. But overall, it's grown between 19x and 20x in 2020 alone. So this is really phenomenal. I gave a speech for Bitcoin Swiss in January of earlier this year, and the market cap was still under $1 billion. And my prediction at that time was this will become $1 billion market. The last year has so exceeded my expectations by growing, not to be above $1 billion, but to be way above $1 billion. So I'm not going to spend too much time on the lexicon, but if you would like to, I have a couple slides here on lexicon. I will just briefly compare CeFi with DeFi. So, a lot of people, early on, a lot of people were kind of thinking like, okay, is BlockFi, is Celsius, is Nexo, is that considered DeFi because they're taking my money and they're lending it out and I'm getting a rate of return similar to if I were to lend it out on a decentralized protocol like Compound. So no, those are centralized finance applications, right? And what's the main key ingredient here is that they're taking custody of your private keys. So, if you're giving up your private keys to a company, you are reintroducing counterparty risk. It doesn't mean you shouldn't do it, let everybody take their own decision, understand the risks fully. But there are a lot of firms in this space that are kind of, for the beginner, it's easy for them to think they're a DeFi application, but if you have to give up your private key, it's really not. It's really not. Regarding metrics, a lot of people, they always quote the total value locked. So that's, what we just quoted, 13.5 billion, 14.5 billion. But this number can be misleading. Why? Number one, a company that's like a protocol that's really well, really well funded, they can park funds, their own funds in their own protocol to inflate this value. Okay, so this can be inflated by the company itself so that people believe it's more successful than it is. Secondly, you have this process of where you can basically, borrow funds, use those funds to lock them up on another protocol or even on that protocol itself. And by yield farming or by constantly borrowing funds in order to take out a new loan and then using those borrowed funds as collateral for the new loan, this artificially can inflate this total value locked figure. So we don't actually really know what the original value locked is. I mean, you could make an upper bound and a lower bound based on collateralization ratios for these different protocols. But like, for example, if I put $100 worth of Ethereum on a MakerDAO CDP, and I have a collateralization ratio of 150%, so that means I can get out about 66 DAI, Now I take those 66 DAI, I send them to Compound as collateral for a loan. Well, Compound's showing that that's locked value, right? But in reality, that's kind of like a derivative. It's like I just sent a synthetic, like I just, well, it's not, DAI's not synthetic, but I mean, I just sent a borrowed money to that, which, you know, it's not that different from our current financial system, which that is how we measure the, you know, the M1. So it's not too far away from how we measure our current monetary system. But the number that I prefer for measuring success or measuring growth is daily active users. And that's because, you know, it's a lot harder to have non-zero account balances and using them on a daily basis. So if you look at this chart, for about the past month or so, I think, yeah, for about the past couple months, we've had around 40,000 measured users per day. And in November, which I'll discuss later, we surpassed the million user in 1 month milestone. Okay, Amy, how much time do I have left? 1 minute.
No, one, just thinking, give me a moment, have to unmute myself. You have 10 more minutes.
Oh, 10 more minutes. Okay, I've been talking too fast then. Okay. In terms of, I'll just quickly go into yield farming because that's a huge topic and everybody seems to want to understand how this works. So as I already kind of discussed, you know, it basically comes from this idea of crop rotating. Okay, so crop rotating on your field, when you basically use the same field or the same asset, but you maximize the return of that asset by planting multiple crops throughout the year or getting, you know, using various strategies on that asset. So, you know, coming from a traditional financial perspective, it's not that different from what we do in our everyday life. So, for example, yield farming is basically the simplest way to put it is finding ways to maximize a rate of return on capital where your capital is normally an Ethereum-based asset. So, you know, there's different ways that yield farmers try to maximize their return. One could be, for example, moving an Ethereum-based asset from one protocol to another if the yield on that protocol is higher. That's not that different from when you have Swiss francs and you go to UBS and you say, how much can I get on a savings, you know, on a bank account? What's my interest rate, APY per year on my money? And then you go to Credit Suisse and you ask them the same thing. So this is really similar concept. Another one is where you can actually, like, let's say that you have USDC, but you realize that rates on USDT are higher. Well, you know, you think to yourself, well, USDT is a little bit riskier. It is a little bit riskier, but the rates are a little bit higher. Maybe I'll put a little bit of my money into that. I'll swap my coins and I will lend those out. I'll provide USDT as liquidity. Well, that's not that different from, you know, taking your Swiss francs and trading them into euros if European Union bank accounts paid a higher interest rate. So that's a really similar concept. Now, where does the yield come from? Well, you know, there's so many different ways now that yield farmers generate yield, but the original one was from transaction fees. So here's a quote from Consensus' latest report on DeFi that came out a couple days ago, like a week ago. It's an excellent report if anybody wants to read that for research. So instead of Wall Street market makers or centralized cryptocurrency exchanges collecting the lion's share of trading fees, automated market makers provided returns and voting rights to anyone willing to add liquidity. Okay, so this is the first, first source of revenue for people that want to yield farm. But now there's been a lot more over time. Okay, so for example, get governance tokens, you know, there'll be like little faucets randomly awarding people. What Uniswap did was pretty unique, where they just gave out, you know, a new token to anyone that had interacted with the protocol earlier this year. But of course, you know, as you get into this space, it gets more and more like risky, let's put it that way. So, you know, there's ways that people can, you know, increase their yields by doing things like leverage, which is this idea where I said earlier, you know, you deposit coins as collateral, you borrow coins, you use those borrowed coins as collateral, and this way you can really like juice your yields, you know, in the same way that somebody would juice their yields by margin trading on the stock market. And you know, this includes risk. You know, if the price of the collateral decreases enough and you get your positions liquidated, you know, you're gonna get wrecked. So there's a lot of risk associated with this. Okay, now I'm almost finished here, but one thing that a lot of people don't talk about is this impermanent loss concept. So I'm not going to focus on it too much here, but you definitely want to look at, you know, is the decentralized exchange that I am providing liquidity to, does that have an automated market maker? And is that automated market maker, you know, what is the formula used to basically figure out the ratios between my coins and the price that I'm charging people that trade with me in my liquidity pool? Because there's Curve and there's Uniswap, and they're using different formulas, and impermanent loss is going to be more or less impacting traders. And there has not been a lot of research done on how much impermanent loss is actually, you know, traders are losing due to impermanent loss. And there hasn't been a lot of research done on ways to lessen your loss, which I'm working on a paper right now that try to figure out some of these strategies. But you know, basically it all has to do with the fact that, you know, a lot of the decentralized exchanges are not connected to the real world. They don't have a way to pull in price data from centralized exchanges where there's where there might be an arbitrage opportunity occurring. And this arbitrage opportunity occurs because, you know, it is decentralized. It's not relying on a single or like a centralized price feed. So there is a potential to lose money. And I can't remember now, but I think I basically read if the price, I have to check, but if the price of your asset, like Ethereum or so, decreases by, I have to forget, but well, anyways, you can see it on this chart. If it decreases by, you know, around, I think it's like around 40% or so, you lose 5% of your value of your coins, you know, of your total return compared to if you had just held and not provided liquidity. Okay, but you guys can definitely check these numbers online. There's a lot of calculators. Uniswap has one, and a lot of other DEXs have one. So, all right, to finalize on a good note, here's some milestones to be proud of. So in February, we passed the $1 billion mark. So that was a huge mark, because all during 2019, we were like in the 700, you know, 100 million to 700 million range. So this was a huge jump up right before the whole shutdown stuff happened. And then in September, Uniswap's trade volume surpassed Coinbase's. So we had a decentralized exchange that had higher trade volume than a centralized exchange. This was pretty phenomenal. In November, we had at least 1 million active users on the various, sorry, this is the top 10 only on Ethereum. So, you know, when you count up all the other ones, and plus there's decentralized applications going on other chains too, like EOS. I don't really follow that, but you know, something's going on there. And finally, because we're working on a report on VCs right now, DeFi raised over 250 million from venture capitalists in 2020. So this is huge. This is a huge number. And Aave, congratulations. I know they're on the panel. They'll speak later. Aave makes up about 13% of that. So that was a fantastic, huge success for you guys. Yeah, awesome. Okay, okay. So in case anybody wants to get a beginner introduction to DeFi, please take this report here. It's pretty in depth. It explains the different platforms, explains, you know, the different risks, different strategies, but it's just an introduction, get to know your players and the general lexicon, metrics, etc. Now, if you want to do an advanced approach where you want to learn about some of the more sophisticated strategies, some of the greater risks, we also wrote an advanced guide that we published about a month ago at our research team at CoinTelegraph. And I just wanted to do a quick shout out. This is Alexander, who has helped us a lot on the DeFi report, and he works closely with our team at CoinTelegraph. And also I wanted to shout out CoinTelegraph. So if anyone has any marketing needs, or we are the largest, we get 10 million views a month on average. And the last couple weeks, last 2 weeks, we've had multiple days with over 1 million views. So huge success at CoinTelegraph. And yeah, thank you. Thanks a lot for having me, Amy.
Demelza, thank you so much. Virtual clap. And the big clap from me. It's always fantastic to have your insights. And I'm going to ask later, what is your prediction for 2021 and beyond during the panel? And I would love to transition now to the second part, where we have the fireside debate. And I hand it over to Ilya, and I would like each three of you to please introduce yourself, and we can kick off the fireside debate now.
Okay, thank you, Amy. So, hey guys, as you can see, for today's fireside debates, we've got very strong speakers, gurus, and evangelists of DeFi. Gustav Arentoft from Maker and Stani Kulechov from Aave. So, guys, would you like to quickly introduce yourself? Gustav?
Yeah, so hey everyone, my name is Gustav. I've been working with the Maker Foundation for a bit over 2 years now, almost coming up on 2.5 years. I'm responsible for European and African business development. Last year, I spent a lot of time in Asia, setting up our business teams out there. So I work really on the partnership side of things, which also makes it so me and Stani, we are quite great friends. So it's good to see you again, Stani. But yeah, so, and Maker is basically, we are the project we also mentioned in the presentation before. We are currently the biggest DeFi project, I believe, in total value locked. And we issue the decentralized stablecoin called DAI. It's the biggest and I think probably the only really significant decentralized stablecoin. So we're really excited to see all the progress that the DeFi has been having in the last 6 months or so. Something that we have theorized about for many years. So it's really good to see it kind of like flourishing. We're still early in the journey, but we're very excited.
Thank you, Gustav. Stani?
Yeah, so my name is Stani. I'm the founder and CEO of Aave. So Aave is a decentralized liquidity protocol in the sense that it's optimized for lending and borrowing. So practically as an end user, you can deposit various cryptographic assets that are on Ethereum network and accepted by the protocol and earn interest. And stablecoins are pretty much the most kind of like deposited asset in the sense that where you're earning yield, and DAI represents quite a big part of it. Yeah, and also you can besides depositing your assets to lend them out and earn, you can also borrow against your assets, so they become as a collateral, or then you can delegate this functionality and delegate your credit line to someone else that you basically trust. And I used to, so a bit of background, I used to develop Web2 financial applications. So what many call these days fintech, financial technology, and now in 2017 practically started to build Web3 financial applications, which is practically DeFi. So kind of like the back end of the new banking world. And 2017, we launched kind of like the first lending protocol, ETH-Lend. And it was actually a smaller community and proof of concept. And over the time, it evolved what Aave is today. And yeah, and pretty excited to be here, especially with Gustav. We're quite a long time friends in the DeFi space, and happy to be here.
Okay, thank you, Stani. So, and my name is Ilya Volkov. I'm CEO of YouHodler and CVA Western Chapter Chair. Guys, I'm a big fan of DeFi, and of course, I believe in the future of this genius idea. But here in this discussion, I'm on the opposite side, and I represent the centralized platform. So I'm not a crazy bastard. I just, on the opposite side for the debate reasons. So let's have fun and let's get started our debates. To start debates, I'd like to say a few words. We had a very nice pre-party during our preparations for this event. And there was a very nice discussion with a bold statement, like pure and idealistic DeFi is similar to pure and idealistic communism. So let me explain a bit. I was born in Soviet Union, and I learned that communism is a very nice framework with just one big issue, with lack of responsibility and lack of liability. So everything around was Soviet, everything around was mine. But no one actually was responsible for that everything. So I guess that DeFi has the same liability issue. We all know that capitalism won out over communism thanks to private ownership rights, correct? So for something to work effectively, it must have an owner, a responsible and liable person. So Soviet communism failed, and we all don't want DeFi to fail, right? But we're lucky, and now we can learn from the past. So I have some number of bold and contradictory statements about DeFi to debate. For example, of course, I'd like to discuss manipulation issues, manipulations with flash loans, with flash loan hacks, and of course, not only. I'd like to speak about KYC and AML issues, about money launderers and stuff like that. And of course, I have questions about skin in the game. And let's probably start from skin in the game topic. So my question is the following. Do DeFi protocol and platform creators have their skin in the game? So basically, who is really liable if DeFi platform fail, if protocol fail? So is there a lack of protection from errors and customer mistakes? Of course, there is no such an issue with CeFi, where is a clear liability. But let's speak about DeFi. Stani, would you like to debate on this topic?
Yeah, definitely. I mean, practically, so I mean, we had a great presentation about what practically decentralized finance is and what kind of tendencies we have seen. But for me, I mean, in general, I see decentralized finance kind of like a wider spectrum, in the sense that, for example, Bitcoin for me is decentralized finance. It's practically a financial platform with incentives model, and Ethereum especially, because practically you have incentives in Ethereum, and with the staking, for example, it pretty much reminds a yield protocol. And the interesting part about today with decentralized finance is the smart contract capability, that you can actually build more functionality. So if you look at practically Bitcoin as it is, and whether, or Ethereum, whether there is responsibility on how the Bitcoin works and so forth, I think the kind of like idea is that you basically aren't putting the responsibility into one single entity, but the whole community is responsible. I think the communist example was interesting in the sense that I never heard that, by the way, before. So that was like the very interesting part. But maybe like as your perspective that you see that kind of like the power is given to the government, and they may make all the kind of like decision making. You don't have to decide. But the thing is with decentralized finance is that actually you become the decision maker yourself, and then at that point it's up to you to basically make those decisions. So you can practically, as a decision maker, decide what's going to be updated, what's going to happen in the Aave protocol, in the Maker protocol, and basically, if you don't want to make those decisions, you can actually delegate that power and decision making to someone else. So I definitely see like this kind of difference in this perspective, but also like in terms of like responsibility and I think the idea of like decentralized finance and smart contracts in general is to build various protections into the protocol. So definitely it's like a sandbox, but it's also like an internet. So the way you could browse internet and browse different kinds of sites, interact with different ways. When it comes to decentralized finance, it's the very same, but practically with finance, you can basically choose different kinds of things, and not just finance. It's practically anything that is on chain, and smart contracts talk to each other. So what decentralized finance is doing is it's taking like practically all of the banking infrastructure and connecting them together to talk with each other to remove inefficiency. In that sense, I think you can create different kinds of protocols. Some of the DeFi protocols are very responsible. They're building different kinds of mechanisms to protect the users and make efficient best execution. Some are lacking this, and the lack might be because of the fact that the development team might be very fresh on what they're doing, or it's a fork of something and there's not much innovation on top. So there's various reasons, but the clear fact is that you could actually build those mechanisms into the DeFi protocols. But I'll leave to Gustav the rest of the.
Yeah, I think like just like the comment on like the communism thing. I think I don't quite agree with the statement, but because like I think that like communism, that was basically all the power to the government, right? And then it came with capitalism. It was at least like in the pure sense of capitalism, like more power to the companies, right? And that is what we have seen, it develop a lot, especially in the tech scene in the US, for example, that like these companies have become more and more powerful, right? And then we have DeFi, where it's power to the consumer, right? I mean, you're completely responsible for your own actions, and of course this represents kind of like a dilemma, right? Because if people, they do things that they don't fully understand, which happens traditionally quite a lot, you will have people making mistakes, right? And the thing in like in decentralized finance and crypto in general, then these things will end up becoming quite punishing potentially, right? Because you could potentially use your funds, you could use some protocol that isn't very safe, or like it gets hacked or something, but in the end, like the responsibility lies on your own hands. Of course there is that is like in the perfect world, of course, of like if you're like a very DeFi fanatic, but of course there's like a long time until that stage gets reached, right? So whenever DeFi protocols start developing, I mean, they still have a developer team. Most of the stuff is done, by a team that actually exists, who they are. So in that sense, when something gets hacked these days, I mean, a lot of people actually come to the team and try to get the team to help them, right? So in that sense, like you have some people who, in some sense is responsible for the project. But at the same time, in the end, like the responsibility lies with the end user. And then I think, so if you're like one of those users who doesn't really understand these things in depth, and I mean, even though, Stani and I, we've quite experienced in this field, I mean, there's still stuff that, pops up every other week that, I mean, I'm sure that like neither of us understands before, we take a look at it. And since we work with it, it's quite easy to take a look at it because it's kind of like connected to our job. But you also have like very mature protocols. So you have protocols that have like shown very strong security roadmaps. Protocols that have been operating for like a long time, that has gone through like several iterations and kind of like reach like a state of like maturity, right? And I think if you take it from kind of like that standpoint, there's definitely places where you can interact with it without needing to be an expert. where you don't take on, unnecessary risks. But of course, with the DeFi boom over the summer, like people were, chasing very high returns, because I don't think that for a lot of people it's probably not like super fun to like borrow DAI and earn like 5% in Aave. It's not really that thrilling. I mean, it's a great use case, and we see people do that as well. But for a lot of the people coming in, they all of a sudden wanted to chase like the very high returns that also were mentioned. This kind of like yield farming craze, and then you kind of like have this section where you have like people who don't really understand the protocols that well, who in the end is kind of responsible for their own actions, to couple together with like protocols that are not mature. And I think that is like a dangerous path that DeFi walked down on this summer. I think it brought a lot of good stuff with it. It made DAI supply explode, and we kind of like still sitting where it kind of like left off. But I definitely see why there's like a lot of people commenting, like debating this topic here, because you want the user to be safe, but at the same time, it's also the user's like own responsibility. So if they choose to do things that even experienced users would deem as being like unsafe, it kind of like you put yourself in a mess, right?
Okay, yeah, sounds like everyone in DeFi has his own skin in the game. Everyone. So
I think that's a good question, because I mean, there's always like reputational risk involved. So I mean, people debate this issue. Nothing is always like very clear. But for example, like let's say auditors who audit smart contracts, should they have skin in the game? And because they just read code, and if there's bugs, like some people might blame them. But end of the day, everyone has reputational skin in the game, unless it's you're participating in something which has completely anonymous setting. That might be more challenging. But also I see this liability actually kind of like removing of the liability with built-in functions in the smart contract, kind of like even better thing that we have, let's say in CeFi or traditional finance. Because I know, for example, that a lender in centralized finance has liability, but if it defaults, that we saw with the I can't remember, Creed or something like that, when they went to bankruptcy. I mean, I kind of understand that there will be like consequences. But then if I have those built-in features in smart contracts, actually I don't need to worry that what will be the consequences and what might happen, because the smart contract will not allow that kind of situation to happen. And I think that is the kind of like a key that for me is very interesting.
Yeah.
Yeah, I think just actually, a comment here as well. Like like in DeFi, you trust the technology, which everyone can see, and you trust the protocols. In CeFi, you have to trust this like black box and like what people put out in like their quarterly reports. I mean, we have this much assets, but like there's no way of actually finding out whether you actually have those assets, because even though you have some very big CeFi protocols, I haven't seen a single report from any of them on like how many assets they actually manage of anything that could be verified on chain. So it's kind of like two different things you have to trust, right? Do you trust yourself and the technology, or do you trust the company? And CeFi is quite similar to like trusting the banks in the past, except that they're not banks, right? They simply are not. They are like fintech startups, with people who doesn't even necessarily need to have any financial background. I'm not saying that CeFi is bad in general, but I'm just saying like it's different levels of trust you need to have.
Yeah. That's true. That's true. So, by the way, it would be really nice to find a way to motivate like auditors of smart contracts. It would be nice to find some way to structure this motivation and liability in the form of some part of a smart contract. Okay, but anyway, let's move on and let's talk about KYC and AML. So, as we all know, one of the biggest concerns for the entire crypto community and for the entire industry is the potential of money laundering, right? So does DeFi have an efficient AML tools? Speaking about CeFi, actually everything is clear. So we have some number of obligations. We have to use a lot of different KYC and AML tools, traditional ones, crypto AML tools, etc., etc. So, guys, what's about DeFi? What's about dirty funds potential to work with dirty funds on DeFi? Gustav, would you like to start?
Yeah, I mean, so there's a lot of these analytical companies out there who does active analytics of the transactions coming in and out. To my knowledge, a lot of the DeFi protocols work with these types of companies. So I mean, I definitely agree that it is like a hot topic. I'm probably not the best one to comment on it because I'm not I don't have a legal background. I know that Stani does, so I'll pass it on to him in a bit. But I mean, I know that like a lot of the protocols, they definitely do what they can on this topic here. But yeah, I mean, it definitely it's very different from the CeFi projects, right? And one of the things which is also quite important to kind of like look into is like, I mean, blockchain in general, like Bitcoin transaction and Ethereum transactions, you cannot impose KYC on like a transactional level on that front, right? So for these assets to kind of like stay true to like the nature of where they come from, I think it's very difficult to impose it on a protocol level. Another thing is also like these applications here, right? I mean, CeFi, they often focus on specific jurisdictions. When you launch an application and a dApp on Ethereum, you're global from day one. So since you enter a global environment and like a global community, that just makes this topic like even more difficult, right? Because like how do you impose something where you're like global from day one, right? But yeah, Stani maybe can give some legal comments on this topic.
One thing is interesting about this kind of like KYC, AML, and so forth is that like I agree that there is not much like commentary on like what is DeFi and how basically you said it, and it's easier to basically look at centralized finance and say that okay, this is kind of like the business model, so practically this kind of like a KYC applies based on the local KYC rules and so forth. But what's interesting here is that like I think we need to start already thinking about the fact that let's say DeFi in its decentralized form, let's say what practically Maker is, what Aave is, and what Uniswap, for example, is. It's practically quite similar to Ethereum or Bitcoin. They do have like some of the properties they have are more decentralized, some are less in the sense. So let's say if you take a look into Bitcoin or Ethereum, there are financial protocols. So basically you transfer funds, right? And they have practically yield curves in the sense that, let's say if you mine blocks, you run the software, you get compensated. And Ethereum staking or staking protocols, you actually get yield for locking funds and validating. And practically what so-called DeFi today is also a financial platform, decentralized in the sense it's decentralized manner governed. It might be secured by a token, which is already in, let's say, one network, or partially or fully with let's say the underlying network, like for example Ethereum. So it's kind of like a continuation what we have. And what we've seen in CeFi, for example, it's very difficult to actually regulate Bitcoin or Ethereum. And I think like you could even try to regulate, but it hasn't happened. So practically what's happened is that practically regulators and actually the market participants are entering into regulation by the services they are providing. So let's say if you are providing services to buy and sell, exchange cryptocurrencies, practically that service is where you're regulated. But the currency itself, the financial protocol like Bitcoin, Ethereum, DeFi in its purest form, aren't practically in the sense that regulated. And this is interesting because let's say if you have a you have a wallet in which is let's say non-custodial, right? So you create a wallet and you basically have a Bitcoin and you can basically interact. So what actually, like if you think about even like from not just the protocol perspective, but thinking about the front end access perspective that we have now in DeFi, different user interfaces, practically there isn't even a wallet because you have to, there's this kind of like a bring your wallet policy. So you bring your ledger, you bring your MetaMask, and then you connect. So you just use a library that the front end provides to connect to the blockchain. and then you interact with without giving the custody. So actually, like, there's even like less kind of like a challenge in that sense. But when it comes to actually AML and KYC in larger sense, the topics are pretty much the same as in Bitcoin. I mean, let's say AML as a kind of like a issue, it's becoming very difficult in the sense that if the gatekeepers, whether it's like centralized exchange or lending providers, are actually kind of like being the gateway and like ports, like on the liquidity that comes and goes, this kind of activity becomes difficult in that sense. And that's kind of like my view. So like, if you have like real DeFi, it's not different from Bitcoin or Ethereum.
Yeah. Okay, very interesting topic, but we are limited in time, so let's try to discuss a couple of more topics. So let's maybe speak about manipulation with flash loans and not only. So as for flash loan hacks, as I remember, maybe I'm wrong, the first successful flash loan attack was on DeFi project BZA. With lost around $350K back in February, and the latest one was with Value DeFi and losses around 6 or 7 million.
There are a few new ones as well.
Yeah. So let's speak about this issue, guys. So, do you see any ways to fix this kind of vulnerabilities? Maybe you have some projections to CeFi. Yeah, Gustav, please.
Yeah, so I think first I think it's pretty important that we kind of like understand what flash loans is, right? So flash loans, pioneered by Aave. So I'm sure Stani has some good comments on this topic as well. But basically, flash loans is just like whenever you have a liquidity pool. So let's say that I put my DAI in Aave. I put let's say there's like $1 million of DAI in Aave. People put in their money, but only 500,000 is currently being borrowed by other people, right? So that means they have 500,000 DAI just sits in the protocol and does nothing. What they then did is that they allow people to borrow these 500,000 DAI almost for free. It's like it has like a very small fee, and all they need to do is they need to return it back at the end of one transaction with the fee paid. So that basically means, if I see an arbitrage opportunity, I can borrow this DAI for free almost, and I can do the arbitrage. Maybe I make 2%, I repay it, and now I've scored 1.5%. So most of what flash loans is being used for is arbitrage. And since this is people just basically doing one bundle transaction, there can be like a lot of transaction, but all within the same block. So it's like a bundle transaction within one block. So you can do 10, 15 transactions, swapping it for other currencies, borrowing, lending, all these kind of things here, and then you just return the money after like at the end of the block and do one transaction. This means that like the flash loan manipulation or like the flash loan stuff is also possible without flash loans. What flash loans did was it democratized the access to capital, right? So before, the only ones who could do these kind of like schemes was people with a lot of money. Now it just allowed everyone to do it. So like before, let's say that I'm the brilliant guy, but Stani is the big whale. We would go together and we would try to do these things, the two of us, and make a profit. But with the flash loans, I could do it alone. I wouldn't need, the guy with the money. I don't need to be a whale myself. So it really democratized the access to be able to do these more complicated transactions. In regards to like protection against it, that basically means that this was always something that the protocols had to protect against, right? This isn't like some new edge case or like some new feature that like Aave implemented that all of a sudden could attack other protocols. This was something that was always possible. You mentioned BCX, they lost, I think it was 3.5 million or something, but they weren't like that big, but like they relied on like a single Oracle price, right? They did something that like all the major DeFi protocols said this is a really bad idea. Do not rely on a single Oracle price. If you do that, you open up yourself to manipulation of that price. So whether the manipulation came from a flash loan or not, I mean, that doesn't matter, right? Because like people could have manipulated without taking a flash loan, you just needed capital. So in that sense, I think that flash loans definitely made this like a more common topic, but it also made it something that people started thinking more and more about. And the good thing about that is that, the industry is still quite young. I mean, we celebrated the MakerDAO 1 year anniversary a couple of weeks ago. I think Aave has their 1 year anniversary of the current version of the protocol soon, and they're launching their version 2 as well. So like, and these are like two of the biggest projects, right? So all of these projects are still relatively new. The size of what we're seeing the industry growing into now is also quite new, and you still have a lot of these like newer projects coming out, which are like not mature, not very well audited. Maybe the team doesn't have the necessary security expertise to actually make a setup that these things doesn't happen to. But I never thought that flash loans was like the issue, right? It like made it a more common appearance because now it was possible for people without capital, but it was always something that the project had to deal with, right? And a lot of these things happen to projects who doesn't take like, who doesn't follow like the industry standards, right? Who doesn't follow, the security regime that like the big projects do. Of course, you have like, outliers, like for example, Compound also had a lot of liquidations not too long ago because they also relied on like a single price source for their markets. So there's also some of the big ones that have done some of these mistakes, right? But I think it more speaks to like the immaturity of like the security level of the protocols if these things happen to them.
Okay. Yeah, Stani, would you like to add something?
Yeah, I mean, it's pretty simple. I think Gustav pretty much summed everything up there, and I think it's quite the same. It's actually not a DeFi, CeFi, TradFi kind of like a separate thing. It's like if you build bad cars, they will, people will crash. If you build, let's say, way to custody user funds on an exchange that has vulnerabilities, it might get hacked and so on. And same for DeFi. Practically, you need to have software that is not just, reliable, but the correct word is kind of like that. It works in the behavior that you practically expect, and that is the thing that you have to develop things very carefully and security in mind. These are financial applications, and the thing with DeFi is that it's just not just like one like black box application. But the beauty of DeFi is that all of the smart contracts are public, so you actually know what's happening. So I could like, if I would go like, let's say as a user to centralized lending provider like YouHodler or let's say Celsius, whatnot, I don't know what's going on there. I mean, I really need to trust what you would say to me in your letter, email letter or something like that. But the thing in DeFi is that you actually see everything, all the transactions, not just the value that is there in smart contracts, but actually like how much is borrowed, how much interest rate is paid. And actually the interesting part for centralized finance is that some of those properties could be actually built in some ways and added as well. So, but in terms of like the flash loans vulnerabilities, it's pretty much like this attack vector existed before, but it just democratizes it, as Gustav said.
Yeah, I think actually that topic brings us back to the skin in the game topic and liability, because speaking about your example with cars, if some engineer builds a bad car and it's proven that somebody died just because of some fault of this particular engineer, he will go to prison. So it's about liability. I'm not sure protocol creators have such a liability, at least yet. So probably in the future.
I'm not sure a car manufacturer has it in that sense, but I mean, I don't think like it's falls on like the individual engineer.
Okay, company.
But,
so
yeah, but I mean, I get the point here. But then again, like I think like in regards to like skin in the game, like if you're like someone who's spent a year building a protocol and something happens, I mean, you have plenty of skin in the game, right? I mean, you would never want your own project to fail. Then you've wasted a year of your life. Your business opportunity is gone. I mean, a lot of the projects that these things happen to, they never recover, right?
Yeah, that's true.
So I don't really like the skin in the game. I understand the topic. Like people want to see, I guess, like legal repercussions against developers, but you know, again, it's very, very difficult also because some of these protocols, they have a lot of community contributions, right? So you know, I think a good example is Yearn .finance. You know, I believe that like most of the contributions come from like people and you know, like not people working for a company, but people submitting code through like an open framework. And you know, Maker, for example, MakerDAO protocol, we also have people who you know, works directly for the protocol. And you know, in the future, this will, you know, come into play in a much bigger way, right? This will be something that like most of the DeFi projects, they're looking to kind of like decentralize themselves completely by you know, opening up for community contributions, right? But I mean, in terms of like skin in the game, if you're like, you know, founding a protocol, I mean, I think you know, you do definitely have skin in the game. I'm not sure to like what lens you would need to have it, you know, but yeah, like I think you definitely have skin in the game.
Okay. So I have one more topic. It's about smart contracts. It's about delays in smart contract updates in case of vulnerabilities. So the core of any DeFi service is a smart contract, right? That cannot be updated instantly in case of vulnerability. That means that if there is a vulnerability or something does not work properly, you have to go through voting process. You have to probably do a fork or even recreate the application. And all of that is time consuming, and additional time could result in additional losses for users, right? So let's discuss this topic. During our pre-party, Gustav has made some good points. Gustav, would you like to start?
Yeah. So I mean, so the reason why, for example, Maker, we have a delay. I'm pretty sure, Stani, you guys have it too, right? Yeah, before any upgrades. It's basically so if you don't have a delay, that basically means that you open up for another attack vector, which is like a majority attack, right? So what if someone pulled enough funds? For example, we have flash loan to push a vote through, and you could do like an instant upgrade, right? You could basically, you know, upgrade the contracts to you know, be manipulated in some way that you could like steal all the collateral, or you could print infinite money, or you know, in Maker, for example, right? So the reason for the delay is to kind of like close off the attack vector, that like if there's a governance attack, there's a very small chance of it actually, you know, being able to proceed. So at Maker, we have on like all the different parts, especially the parts that are like more prone to attacks known in the industry. For example, the oracles, we have security measures around each oracle. So for example, we have a 1 hour delay on all of our oracles before they come into the system. And that basically means that if someone manages to manipulate the price of an oracle, we can go in and we can freeze that asset. So, you know, it will be frozen at the price, at the last given price, for example, right? But yeah, I mean, if someone managed to somehow, you know, figure out some way of a vulnerability, there's basically this delay, which is in the protocol to make sure that, you know, if there's a governance attack, you know, you're basically resilient against that one, right? And I think one of the interesting things about this topic was that, for example, the end of last year, when Maker was recently launched, we didn't have a delay on the governance, because at that point we saw that like the chance of a bug in the smart contracts, you know, potentially would be greater than the chance of a governance attack. And the community, like a guy from the community, he like wrote this like, you know, quite aggressive blog post about it, and kind of like went in and said, oh, like you can you know, you can steal all the money in Maker by doing A, B, and C. So like what you always want to do as a protocol is you want to look at, okay, what is the most likely attack vectors that you have, and how do you protect yourself against them? So as the project matures, and as you know, you have gone through these, I mean, we have a full formal verification on Maker, for example. So, you know, people basically you know, using mathematics and algorithms to calculate vulnerabilities in the protocol. So running through like a lot of different scenarios in the protocols. We also had like, I think it's like 3 or 4 different auditing companies auditing the system in complete, including, you know, the best from both like Asia, the best from the US, top auditing companies from Europe. So we really have had like this like very, very rigorous security auditing scheme around the protocol. And you know, continuous bug bounties and so on. So like having done all that work on the security front, we then, you know, have come to a point where like if an attack is going to happen, it's probably not going to be, someone breaking our code, unless that, someone comes out smarter than all of these other guys that looked at it and find something that they haven't found, which seems very unlikely. So that's why you chose to have these like delays in the upgradability. Is like as the protocols mature, you think that like the potential like a governance attack might be bigger, and you really want to make sure that doesn't happen, right? But it's very common for every protocol to have some kind of delay before changes gets implemented, so you kind of like can go in and be resilient against malicious actors in governance that over time becomes like the most likely attack vector.
Okay, guys, we have just a few minutes left. So Stani, would you like to add to this topic?
Yeah, I mean, it's like decentralization is a process, and kind of like you want that things are not changed kind of easily, so there's like certainty, but you don't want it to be in the beginning, kind of like you want to this to happen progressively, in the sense that, let's say in the beginning you might want to have more control as the Genesis team, so you can fix bugs quicker, but over the time kind of like passes, and the more value there is in the protocol, let's say for example, in 12 months, there might be 50 to let's say 100 billion, just a number, of locked assets in Maker, in Aave, and in that point, like you kind of like want that things can't just be easily changed in the sense that there's this certainty, right? But in the beginning, you want to keep the kind of like the flexibility of changing, and like some of the DeFi protocols are very like kind of like there's sort of due diligence. There's like in Maker, in for example, Aave version 2, we have 5 audits, formal verification, and and also white hackers looking at the code. So there is sort of effort put into the whole security aspect, but still you kind of like in the beginning want to have that control.
Okay, perfect. So let's maybe recap the debate and summarize our takeaways in 30 seconds. I mean 30 seconds each. So Gustav, your 30 seconds.
Yeah, I think that we have seen a tremendous growth in DeFi. DeFi definitely is starting to prove that it's here to stay. The innovation level in this topic specifically is just very, very high. It's really manifested itself as like one of the prime use cases for Ethereum in its current stage. So if you're like interested in this topic and you think it's exciting, I can definitely recommend you looking more into it. It's definitely not something that will vanish tomorrow or anything like that. And working in DeFi is also tremendously fun, especially when we get to meet each other, and there's a lot of awesome people here. So like if you have any interest in the space, I could definitely recommend that you start spending more time in it. Maybe on the periphery, maybe for one of the projects. It's a lot of fun.
Okay, perfect. Stani?
Yeah, I mean, it's getting more interesting. I mean, now pretty much like DeFi now is becoming like a very interesting ecosystem, and it just grows. And once there's going to be more things on top of Ethereum and on chain, I think DeFi could be like a backbone of everything that will happen in this space. And as like smart contracts talk to each other, this is going to be like very, very very fascinating. I kind of like I predicted that that maybe like 5 years this DeFi thing could be very interesting, but I don't think there is an ending here, because the amount of things that could come into the space, not just like DeFi, but on chain like value and so forth. It's just it's every day is more exciting than the previous one. So I mean, this is like we all are kind of like blessed to be here now, because this is like super amazing what's happening in the DeFi space.
Okay. So my 30 seconds. In my opinion, DeFi has a moral responsibility to the crypto community. Just because DeFi has made enormous headlines over the past year, and the eyes of the world are watching. So, and to be serious, DeFi, of course, is a great idea, but I think, as always, the truth is somewhere in the middle. And I believe that the proper combination of DeFi and CeFi will bring a huge value to the industry. So actually, I believe in a hybrid approach. Industry is still young, and I think we will collect this puzzle with some pieces from DeFi part and some pieces from CeFi part. So thank you guys for this interesting discussion, debates. Passing mic to Amy. Amy.
Cheers, and thank you so much, Ilya. Thank you, Stani. Thank you, Gustav. This was a very friendly debate. I must say. And
maybe we're losing you a little bit.
Can transition to the third part where poor. So how is it now? Is it better?
Yes.
Yeah, now we can hear you.
Okay. Amy,
Okay.
we lost you.
Okay. How about now?
A bit better.
Okay. So I will just ask the first question from Gaspard, because he's representing. Please tell us about APWine or APWine, and tell us what challenges are you addressing, and yeah, it's nice to see a new company, how a new company came about, because basically you are on testnet now. So, but I don't want to answer the question. So please introduce yourself and tell us more about the company.
Hi everyone, thank you, Amy. I'm Gaspard Peduzzi. I'm a computer science student at EPFL in Switzerland. And I'm also the president of the Blockchain Student Association there. So we launched APWine with other students and alumni, which has for goal to allow trading future yield. So we basically try to address a need for two main actors. First, liquidity providers. We want to allow them to be able to hedge their risk, selling their yield or part of the yield in advance at different rates. And also for the traders, we want to allow them to be able to speculate on the volatility and of those APY, those annual percentage yield. So we work with a system of future, and yeah, liquidity providers can sell their future yield to traders that can then speculate on that. We saw that some protocols have extremely volatile annual percentage yield that sometimes go to 1,000% or hundreds. And it's a market that is moving a lot, and I think we try to bring a tool for liquidity provider to make this this ecosystem more usable as well for them. So it's a solution for the short term, for a period where we see projects coming every day and a market changing a lot, and also for the long term, for maybe other type of actor, bigger ones as well. Yeah, to make this market more usable. So indeed, currently we shipped a first alpha version pretty quickly. We started the development late in August. And now we just released a second version of alpha, much more resembling to what will be APWine for the main version, integrating Aave as well. And so we're doing audits to be able to ship the protocol in January 2020. So right now we are integrating DeFi protocols for this yield, but we are also looking at other type of return on investment. For example, with the staking, for example, Ethereum 2.0, that would be things that we would like to integrate, because we think there is a value and need in the fact of both hedging your risk and selling it at selling in advance yield at a fixed rate, and for the trader as well to be able to trade on this volatility.
Fantastic. Thank you so much for the introduction. Now everyone did stop the video, but I would like to invite back Demelza, because the next question is going to be addressed to her. And we have not talked at all about Ethereum 2.0. And yesterday the Beacon chain launched, and this is a super exciting time. And Demelza, you have been researching Ethereum 2. So what is your take and give us a bit more insights, like what do you think, when will we get to stage 1.5? Curious to hear your thoughts.
Sure. Well, congratulations that ETH 2.0 launched. That's exciting. That's exciting for all of us. About 2 weeks ago, I thought, we were too far away from launching, but we did do it. So that's great. Milestone achieved. And also, it ties into the debate that you had earlier, because there will be some changes. There's some people that are kind of like Bitcoin maximalist, or they like other altcoins, outside of Ethereum. And, people like even Willy Woo. Willy Woo came on to Laura Shin's podcast, and they were discussing how, DeFi is going to break down on ETH 2.0 because, now you're going to have sharding, and you're going to have multiple chains. And instead of just, one ETH chain, you're going to have like 64 shards underneath one big beacon main chain, and that it would be hard to have DeFi work because you're going to have parallelized validation of transactions, and for DeFi you need kind of you need synchrony. You need all transactions being validated at the same time by all nodes. Well, there's been a lot of evidence against that argument, mainly that, in the future, even if DeFi is all contained in just one shard, and that's we don't even use multiple shards, DeFi won't get worse than it is now. It'll just stay on one shard, and it will have the same high transaction fees and same latency, confirmation times that we currently experience. So in a worst case scenario, DeFi is going to be as bad as it is now in terms of confirmation times and transaction fees, but it can improve a lot as well if they find ways to enable DeFi to exist on multiple shards, which many companies are already working on with techniques like yanking and other strategies. But overall, there's these kind of long atomic swaps like flash loans. Those might go the way of the dodo, so to speak. So we might lose flash loans, which but there's potential. There's ways that even flash loans could continue to work, especially within a single shard. So a system that's contained within a shard could still be impacted by arbitrageurs using flash loans. So we're going to have a lot of changes, but I think overall a lot of the kind of fear, uncertainty, and doubt against DeFi on ETH 2.0 is it's a little bit because people either want to see Bitcoin maximalism, or they want to see other chains that they've invested in go up in value. So be careful what you read.
Fantastic. Thanks so much. And, yeah, this is also making the Ethereum network more secure, and Ethereum loves to present. And yeah, it's just fascinating to me from across the globe. The participant connection is unstable. So I hope you guys can still hear me. Hello?
Yes,
Can you
yes.
hear me? Okay,
Yep.
I just had to turn the video off for a moment because I think it's choppy. So Ilya, the next question is dedicated to you because you integrated Maker, Compound, and Uniswap into the lending platform, into YouHodler. And what is the biggest learning through this journey? I guess all the YouHodler users are beyond happy about this. So curious to hear your thoughts.
Yeah, definitely. So the main learning is that DeFi funds are different to other crypto adopters. And this is actually very interesting. So we've got a lot of interesting learnings about DeFi fans. So first, DeFi fans are mostly millennials or even younger. So second, they're 2 times more active with conversions from one crypto asset to another crypto asset. Third, they're more active traders and they have more appetite to the risk. Then they prefer mobile versus web, and they're more frequently visiting the app, on average 2 times more. And they prefer long positions over short positions. In simple terms, they're more open to new products and services, and they're much more active in trading, and they believe in the future growth. So again, my personal learning was that DeFi traders, DeFi hodlers are really very different to the majority of crypto adopters. So this is really very interesting.
Excellent. So the next question is going to be, let's try with the video. Let me know if it's choppy again. So the next question is to Demelza, and because of course this also changes with the huge volume coming to the space from peer-to-peer. We are going more to liquidity pools. So curious to hear your thoughts, Demelza. You're on mute.
Sorry, thanks, Emmy. So what's the question exactly? So we're moving from centralized exchanges to decentralized exchanges, and kind of my thoughts on that, or what's the question? Sorry, I didn't hear that part. Kind of chopped out. Is my connection bad, or I'm not hearing Emmy? Is anyone hearing Emmy?
I'm here and I can hear you well. So yeah, we've lost Emmy.
Well, I'm not sure what the question was, but I'll just comment that I really appreciate that there's no KYC AML on decentralized finance. So
You're all back.
Oh, welcome back, Emmy.
Hi,
welcome
everyone.
Back.
Good.
Sorry, Emmy.
Okay. Could you repeat the question? Did you get the question, Demelza?
Sorry, no.
Okay, so the question again. So through the rise of DeFi, because so much volume came into the space, we've seen, so like as we grow, maybe new governance models make sense. And I'm curious to hear if you have any thought emerge. A lot of protocols are coming out with V2 and or V3 even, and just curious if you have specific thoughts on this.
Well, I think this goes back to that debate you had on communism, which was just fantastic. It's like, who makes the decisions at the end of the day, and who's responsible if things go wrong? I've seen a lot of, I live in a monarchy, I live in Liechtenstein, and I really like this monarchy. And, I came from a democracy, or a representative democracy in USA, and I haven't liked the way that's been going for like last 70 years or so. So, but then of course there's dictatorships that have been, horrible, which are, kind of similar to monarchy. So, I think you have to have really talented people. I think, competence and IQ and natural talent and drive, motivation to succeed, motivation to keep fixing. It's about individual people that really run the show at the end of the day. And yeah, it's good to have like voting, participation, governance tokens, and you can vote and you can share your thoughts, but you can't have too many, bosses running around and nobody doing the actual work either. So I'm not sure about governance models, overall, what's the best one? There's tons of research on how to organize social systems, which is I'm not an expert on. And I think, different cultures in different times require different solutions. I'm not sure there is a universal one, but I do think it's great that the market will, you know, allow these different governance experiments to compete, and we will vote with our digital assets, so to speak, on which governance models we prefer. So, you know, I do think it's open to the market to reveal kind of which ones work the most in the highest probabilities. So yeah.
Thank you so much, Demelza. My fiber net is not, it seems to be something else today. It's definitely not a fiberglass. I'm sorry for being choppy. So the next question is to Gaspard, and we briefly talked about yield farming because this is what the APWine is addressing. So can you tell us about the current challenges of yield farming and how are you seeing the challenges disappear, or how are we finding remedies to these challenges?
So in no particular order, well, it was mentioned, but security is some kind of issue where it's a gold rush, and as in every gold rush, people want to be the first putting their funds on new protocols, but also protocols want to be the first to be on mainnet. And so we have a lot of protocols that are not mature enough and not audited, not well audited sometimes, and so I'm just not ready to have a very large amount of funds locked in them. And so we see protocols that are built extremely rapidly and not audited, and we have in like 24 hours $500 million of funds locked there. So of course, I think we need to definitely, it's definitely a challenge and something that we need to look at, and we need more time for the protocol to become more mature. We also have the issue of volatility a bit linked to these particular times, and the fact that new protocols are coming every day, and then people are moving their fund from one to another just to have the bigger rates, the bigger returns on an investment, and so extremely volatile. So for one that is not very, let's say, always connected and checking all this return, it might be an issue, a challenge. And I mean, there is also the usability part for example, for gas price. So for transaction cost, as it was mentioned, it's quite costly depending on the day, the hour, or just when you're interacting with some protocol. Sometimes it costs a lot. And so it makes DeFi not usable by some category of user that does not necessarily have the amount of fund necessary for them for this interaction to still be profitable. So there we need to look at the scalability solutions, and then we'll have to see how we can still have the composability of the DeFi ecosystem with all those projects and bring scalability to them.
Fantastic. Then I have the chance now to ask Gustav about the collateral. Okay, I see I'm breaking again. So Gustav, could you tell us about MakerDAO's new collateral relating to real world assets? And what do you see in the short run and the long run for MakerDAO?
Okay, so basically, the community has been working on.
Okay, I'm going to repeat. Can you hear me now?
I did hear the question too.
Can you hear me now?
Yes, I did hear your question as well.
Okay, excellent. Then please go.
Okay, yeah. So basically, the community has been working quite a lot the last 12 months on kind of like the initial vision that was mentioned in the white paper that was written all the way back in 2015, which is to not only be able to use crypto native assets, but also to be able to use kind of like what we call real world assets as collateral in the protocol. So here in December, we actually go like the protocol is going live with the first couple of them. So basically financing more traditional companies with the assets that they have on their balance sheet, but using DeFi to do so. So this is like a really, really big milestone, I think, for like the entire DeFi community, because kind of like one of the things that we see holding back the DeFi community now is that we only have the assets that kind of like are available in the blockchain now. I mean, we could potentially get like new projects, you know, we could also get like a big influx of capital from like retail investors that will make the current assets go up in value. But in general, we're like pretty limited to the current section of assets. And it is still like a pretty limited space. But to be able to tap into the traditional markets and use that as collateral, that really improves the scalability of the DeFi use case, right? And one of the key things that Maker is really looking to do is to be able to improve the lives for people all around the world who needs, you know, a decentralized, stable asset. Because you know there's a lot of people around the world that lives in environments where the local financial system, you know, isn't reliable or doesn't really work. I lived in Argentina myself for a year and a half, and in these places they really need an asset like DAI. However, with the current market cap of DAI, we simply don't have enough supply to service all of these people. So we really need DeFi to scale. And you know, I think also personally that one of the great opportunities for DeFi to scale is to become something that people, you know, ordinary people use, ordinary businesses use, and not just people who hold crypto native assets. So this is kind of like the path that like the community, you know, has been pushing quite a lot, and the, you know, I'm personally very excited about it. So, you know, in the next 12 months, you know, I'm really looking forward to see a lot of these types of assets coming into the protocol and being used in a bigger way. And another positive thing about whenever people, they then, you know, like take a loan up with DAI, they will basically also sell DAI in the market immediately. They will, you know, generate positive fees for the system. They will help with you know, maintaining the peg. And you know, it's also, you know, a dream that, you know, potentially that will enable us to put the DSR back on the table again, so people again will be able to natively earn an interest rate for holding DAI.
Excellent, thank you. I hope you guys can hear me now. So people are going to just DAO it, I guess.
Hopefully.
But you went into the predictions for 2021, which is the closing question because we are running out of time. So a quick 30 seconds for everyone. Last question. What is your prediction for DeFi for 2021? Is DeFi going to eat up the volume of CeFi, or what is going to happen? Ilya, let's go.
Okay, so I'm excited about combination of CeFi and DeFi. And of course, I'm excited about fixing the responsibility issues on DeFi. So I believe in 2021, we'll have a great progress and we will have a lot of fun. A lot of fun, as always, with crypto. So that's
Cheers
it.
to that. Thank you. Who goes next? Demelza?
Sure. I'm trying to think of who said it now. It was a good quote. I think it might have been Michael from Framework Ventures. I can't remember, but somebody said, you know, we still need CeFi because we need a gateway into DeFi. Like we have all this fiat and we need to like get rid of it somehow. So I do think, you know, both are going to be big. And, you know, as different countries, you know, kind of put pressure on the gateways to do more and more regulation and more centralization. And I do think DeFi is going to grow and continue to grow, and eventually will be a parallel financial system where we're going to have half the world, you know, basically, or more than half operating in the traditional monetary system and having their currencies debased. And then we're going to have a group of people that are living in a parallel financial system in DeFi. So I do think that'll happen. And we're just going to continue to get more and more value locked and assets under management in this ecosystem.
Fantastic. Thank you so much. Gaspard or Gustav? Gustav,
Yeah,
you're just going to DAO. Everyone will DAO it.
I think we're going to continue to see kind of like the trend where the decentralized applications, as they have solved a lot of the user experience issues, will continue to grow in a really, really big way. I don't think we'll see quite the same boom as we saw in like over the summer. But I think it kind of like speaks a little bit for itself that Uniswap now does more volume than Coinbase, and Maker and Aave and Compound has at least to my knowledge a lot more capital than the retail CeFi platforms, and I think we will continue to see this. I think people get more educated, they get more responsible, and of course they want to stay non-custodial.
Cheers to that. Gaspard?
And I think for the new year, two different things. I definitely think there is a space for the volume to grow, and then new actors to get on board on this trend. But I'm looking forward, and I think we need definitely to see protocol matures and yeah, to make this ecosystem more usable as well.
Thank you very much. We are going to be here and we will be following what's happening in DeFi, and we would like to have you all back sometime next year for another discussion on DeFi, of course. And I'm putting my hands together to all of you. Thank you, Demelza, Gustav, Gaspard, Ilya, and Stani, and bye for now. And thank you very much on behalf of the CDA.